If you want a good dividend stock for your tax-free savings account, one of the best stocks you can buy is Fortis. The utility company is one of the most stable long-term investments you can own. It generates consistent recurring revenue, and it has been growing and expanding its reach and customer base. That means more recurring revenue, and along with its strong profit margins, its earnings are likely to continue growing. You're probably not going to get a huge return from owning the stock, but if it's top dividend you're after, then Fortis is a stock you'll want to check out. Fortis' stock currently yields 4%, which is a fairly high payout, and it's also a fairly safe one as well. This is the type of stock you can buy and hold and not worry about. Fortis has a beta value of around 0.2, which means that even though the stock market may go on big swings occasionally, Fortis won't. The lower that beta value is, the less the stock moves along with the markets. At 0.2, Fortis isn't likely to jump in value if the market has a big day, nor will it crash if it has a bad one. And that's one of the big reasons you can hang on to it for years, the stability. In 5 years, Fortis' stock has risen by just 5%, which may look disappointing when you consider the S&P 500 has risen by more than 87%, and even the TSX is up around 46% during that time. That's one of the trade-offs with Fortis. In exchange for that stability, you sacrifice the possibility of earning a big return if the market is doing well. But if the market isn't doing so well, it can be a safe place to put your money into. Another good reason to buy the stock is it's trading at a reasonable valuation, just 19 times its trailing earnings. That's not bad for a business that's still growing at a reasonable rate. From just under $9 billion in revenue in 2020 to now posting more than $11 billion in sales over its last 4 quarters, Fortis is still showing a lot of good growth. And its profits have also increased as the company averages a solid profit margin of around 14%. Fortis has a huge presence in North America, and the company has a 5-year capital plan that will see it spend $26 billion, which it says is the largest capital plan to date. And beyond the 5-year plan, the company is looking at opportunities in the US Midwest to get even bigger, expand its footprint, and add even more customers along the way. Its strong earnings allow the company to not only continue paying its dividend, but also to increase it. Fortis has a payout ratio of around 70% right now. And last year, the company announced an increase of 4.2% to the payout. And that's the 51st consecutive year that it's raised its dividend. And investors can still expect more increases, as Fortis projects that through 2029, its dividend will grow between an annual rate of 4% and 6%. The stock already offers a great yield of 4%, and on top of that, it's also increasing its dividend. That gives you plenty of incentive to just hang on to the stock in your TFSA, since all that dividend income won't be taxable. Fortis is a great buy if you want a dividend. While I wouldn't count on it for huge returns, it can definitely make for a solid go-to stock to invest in if you're not sure what to buy. After all, if nothing else, it can be a good place to park your money and collect a dividend along the way. It's one of the TSX's largest and most popular stocks, and for good reason. It's an investment you don't have to worry about. And for TFSA investors, this is a great stock to just buy and forget about.